we started going through a lot of typical metrics for real estate deals. We started off with the cap rate. And actually, I'm going to take a link to this and I'll drop it in the chat so that you all can get the spreadsheet as well. But at the end of last year, we were talking a little bit each meeting about different metrics and how they're used to evaluate not only real estate deals, but private equity deals in general. A lot of them are similar to how you do analysis on businesses as well. Some of these techniques can be applied because a real estate investment that owns something like an apartment is a business, and it has all the standard business metrics that come along with it, as well as some, specific real estate terminology. But we went through the cap rate, where we explained the cap rate is simply the ratio of the income to the property value. So let me jump over to our example actually today. If you've got a $10 million property and it generates $600,000 a year, that means your cap rate is 6%. It's a fairly straightforward equation, and people talk about that all the time in the industry. It has a lot of shortcomings. It's not the greatest way necessarily to describe a project. There are a lot of other details, but it's a quick metric on how much money does a particular property make versus its value. So today we're going to talk about the IRR. And Betsy, I hope you're there and you're getting set up. I haven't heard anything from you yet.
I'm here.
You're there. Okay, great.
Tried to join earlier, but the link was not working, so I had to re-register. But I'm here and ready whenever you are. So just let me know.
I'll just take a few minutes and talk about the IRR, and then I'll turn it over to you.
Okay.
So here's our example. For those of you who didn't get it, I put the link in the chat. I'll do it one more time in case people joined it and get the link. This is our workbook for real estate metrics. And in this particular IRR profile, we are going to take the same example that we have over here in our cash on cash return. We calculated that value right here. We're going to add to it the internal rate of return and the total profit. Now, internal rate of return can be kind of difficult to understand when you're new to the industry. The internal rate of return, and I've got a big definition down here, it's a financial metric that tries to, or it does analyze, basically what it does is it takes every cash flow that a particular property creates or generates, including the initial cash in, any cash flows during the life of the property, as well as the cash coming out of the property. And it summarizes those. You can either take a levered IRR, which is the summary of those things before you include your mortgage, your debt service, or you can take a levered IRR, which is after you include the debt service. And what it does is it takes a time value calculation of every single cash flow, and then it determines what's the discount rate that makes the net present value of all of those cash flows zero. It's kind of a little unintuitive to think about it that way, but basically you're trying to ask, what rate of return do I need in order to make the net present value, your current net present value, zero? So here's the formal definition down here. And if we go through an example of purchase price, closing costs, and a going in cap rate, we're going to lay out a timeline over a 10-year period. We've got our closing costs here. Each one of these lines is a cash flow. So the first cash flow is our net operating income, which is income minus expenses. And we know that if a property's $10 million and it's got a 6% cap rate, that means it's making $600,000 a year. And you can lay that out with an annual growth factor over any number of years. And this is actually a dynamic model. So if I wanted to bring this down to 4 years or 8 or 9 years, whatever we want to do it to, we can run it out to those numbers. And then we're going to take into account our rehab budget. which is right here. So we're going to put in $100,000 over a 2-year time period, year 1, year 2. And we can change that, of course, too, if we want to put it over a 4-year time period. And then to calculate the loan, we're going to put in our loan to value ratio. So if we have a $10 million property, 65% loan to value ratio, then we're borrowing $6.5 million. We'll throw in a couple of fees and interest rate and how many years we're going to amortize it over in order to be calculated out. Here are loan proceeds. And when you add these together, you're going to come up with your debt service, your cash flow after. This is the cash flow you bring in minus your renovation costs. And then I'm summarizing it before you add in your mortgage. Then we're going to take our principal and interest payments for the mortgage. In this case, we're just paying principal and interest. A lot of times in commercial deals, you'll have interest-only deals for the first couple of years, depending on your loan agreement. Excuse me. And then we'll take the cash flows from your purchase price and your sales. We will add them all together. And then we'll put in the proceeds from the loan and the loan payoff, as well as the loan fees. Once those are all summarized together, the internal rate of return is actually just a spreadsheet function that will calculate over this time period what your rate of return is. And so it's fairly easy to implement. As you can see here, it's just, if I highlight it here, it's taking the IRR over this range here. We can see our cash flow, and that was calculated on this previous tab. And then average cash on cash is simply the average over the years. But then the internal rate of return is down here. Now, one thing before I turn it over to you, sorry, Betsy, I am going a little long.
No worries.
The one thing to understand about the internal rate of return is that there is a maximizing function that most general partners will try to hit. And that maximizing function tends to be right after you do your renovations. You have a stabilization period and a little bit of a growth period. Oftentimes, it tends to be around a 4 or 5 year time period. But of course, that all depends on the bids and the asks that you get on your property. So, and since this is a time value calculation, it's extremely sensitive to how many years it's spread over. So let's say we were to do the same thing, but spread it over 3 years instead of 7 years. You suddenly go from a 3 to a 6. Wait a moment. So I'm looking at this, and I thought the number should have gone up. I'll look at that a little bit. Let me know if I have an error in here somewhere. Normally, when the time period is shrunk, the internal rate of return goes up. It all depends on your particular deal. Anyway, have fun with this spreadsheet. And if you have any questions, feel free to write the group. We have our Discord server, which I haven't talked about in a little while. I'll drop a link to it while Vessie is talking. All right, Vessie, is over to you. You can either share your screen or I can share your presentation here.
Let me share this way I can drive versus asking you every second, next.
All right, sounds good.
I think that would be more efficient. So let me share my screen. All right. Well, thanks again, Daniel, for having me on. And glad to hear you're recovering slowly but surely. But sorry about the illness. Hope you get better soon. But really happy to be here and excited to talk to this group today. So first, I wanted to introduce myself, Vessie Kapan. I'm the founder of Dream, Believe, Achieve Capital Group based here in Los Angeles. What I thought I would do today is I'll kick it off with a very brief background and experience, how it relates to underwriting, which is one of my superpowers in vetting deals. And perhaps some of you or many of you will relate to my journey, because I wasn't just born and hop into real estate, and which I'm blessed to do full time today. It has been a journey. It has taken years, but I'm so glad that I started, and the only regret I have is not starting sooner. So we're going to talk briefly about that. Then I will take you through the key steps to vet a deal, which is something that has been extremely helpful in my own journey. And now I have the privilege of helping others to do that as well. And lastly, I'll open it up for Q&A, and hopefully we'll get all of your questions answered. And before we begin, just a quick disclaimer. Of course, none of what I share is tax, legal, accounting, and individually tailored investment advice. So very quickly, I was actually originally from Bulgaria, and I grew up at a very different time, not only different place, but also different time behind the Iron Curtain. Bulgaria at the time was a communist country. And so there wasn't really a stock market in place. There is now, but nothing, again, compared to what the US has. So when people talked about investments, very often they referenced hard assets, namely real estate, maybe some gold, silver, basically commodity-like investments. And it wasn't even cash flowing real estate. It was, people were lucky to be able to eventually buy a home and pass it on from generation to generation. But that seed, so I guess that seed was planted in me, but it took some time until it germinates. I followed the more traditional path of going to school and joining a firm and climbing the corporate ladder, until I realized one day that I was climbing the wrong ladder. And there were a number of events or clues, you could say, that were all along the way, that were there all along, but it took me a while to pick them up. One being the 08-09 crisis, which unfortunately left a lot of people either without jobs or with their retirement portfolios decimated, or both. The second was my own employer went through a couple of restructures, and the last one was particularly painful because I saw 70% of my colleagues suddenly being let go. And that had nothing to do with how smart they were, how hardworking they were. Some were retirement age, but not ready to retire, so they were effectively forced to retire. Others were younger and primary breadwinners, and all of a sudden they had no job. So I survived, but that really caused me to take a step back and think, wow, what if I'm next? I was probably kept on due to luck and possibly because I was paid less. So in that type of financial decision, they decided to keep me. But what if that happens to me tomorrow? And that's when I think the real estate seed germinated. It was in that moment of crisis. And so I started reading a lot, attending meetups and forums like the one you guys are joining today, really connecting with like-minded individuals. And at one of those meetups, one of the presenters would very frequently talk about investing out of state. And so one day I called him and I asked, hey, do you know someone who sells properties out of state? And he said, sure enough, I do. And that happened to be in Memphis, Tennessee. And of course, I did my research on the market and submarket. And luckily for me, I had some familiarity with Memphis since I had visited a few times before, mostly for tourist reasons, since I lived in the South for many years. And decided to basically take action. Bought that very first home. It was very scary. Again, being in Los Angeles, it was impossible for me to buy something here. One, due to the price point, but two, I wanted to have a cash flowing investment. And unless I put a very substantial amount down, that would have been very difficult to achieve here, even to this date. So that naturally pushed me out of state. And I'm so glad I took that step, because that investment did well, and eventually it led me to buy another and another. And that's where I think the light bulb went on, when I thought, wow, this is not just a small retirement nest egg. This can be something bigger that can create a pretty substantial income stream and help me be more job optional, or even better, if God forbid that happens to me, like it happened to my colleague, I'll have other options to consider other than running back to a job. And as I thought, well, how do I scale this? And it became very apparent very quickly that I'll have to buy hundreds of single family homes, and that wasn't really achievable. And that's when I thought about multifamily. Why did I think about scaling into multifamily? A couple of reasons. One, I thought I could leverage my skill set of managing the manager, investing remotely. And while it is a different asset class, it's still in the residential space. So there were a lot of transferable skills I could apply there. Secondly, at the time I was a commercial lender, and I had the privilege of, well, my primary activity was managing a pretty sizable portfolio of multinational loans for a very short period of time, or a couple of years. I had the privilege of working in our domestic department when a very sizable chunk of the business was real estate, multifamily, commercial retail. We had a couple other asset classes in there. But that also helped me see that I was sitting really on the wrong side of the equation. So I decided to make that transition, and as everything I do, my first step was getting educated. So coming to clubs like Daniel's, where you're all learning and growing together, that's extremely, extremely important. I got educated, got into a mastermind that connected with other investors, other like-minded individuals, and it worked really hard, underwrote hundreds of properties until I found the one, but eventually it happened. And since then, I've been able to grow my portfolio, partner up with more operators as well as passive investors. And now I have the privilege of helping others invest in real estate and diversify their portfolios and create multiple income streams. But what I really wanted to cover today are the key steps to vetting an investment opportunity, because that has been something incredibly helpful in my own journey. And especially in the current environment, real estate goes through cycles like many investments, and we're in winter season right now, but spring is around the corner. Although irrespective of the season, it's always important to go back to basics, right? Lean into basics and prudently vet the investment opportunity. Because as one of my mentors likes to say, numbers don't lie, sure, but I can make them say anything I want. And I see that across the space quite commonly, depending on people's risk tolerances or experience levels, what type of assumptions they make to create those pro forma models, those pro forma cash flows that can make the numbers look amazing on paper, but behind the surface, there's a lot of underlying risk with that investment opportunity. So usually where I typically start when that investment opportunity is presented to me, again, I invest both actively and passively. I start with the market and submarket, because there are a lot of things you can do to a property to execute on the business plan. There are a lot of things you can do to improve it, but the one thing you cannot do is lift it and shift it to a different location. And the market is really key in terms of influence business plan, and I like to call it the tailwind during tough times, and that propels you further during good times. But the underlying market dynamics really drive a lot of the assumptions that later on either you as an operator or an investor would study to figure out or implement to figure out, is this a good investment or a bad investment? So that brings me to the next item, which is top line assumptions. And if there are two items that can impact the value of a deal exponentially, that's one of those, is the top line assumptions, particularly when it comes to rent growth. We were very blessed in the past couple of years to see pretty sizable rent increases, but those are very unusual in nature. So really understanding what the rental comps look like, what is the historical rent growth for a particular area would give you a really good insight on are the assumptions presented to me realistic or not. And if they're deviating from those historical averages, then at a minimum, you asking the question to the sponsor, why do you feel good about these assumptions? Let's talk through that. Let's go through the detail. Because again, the rents and the other factor that I'll get to in a moment have an exponential impact on the valuation of the property. Then number 3, I would say, is expense assumptions, and really understand, have those been adjusted to reflect what the property will look like post-close. The 2 largest items, insurance and taxes, are items that typically adjust. Now, taxes really depend on the county. In some cases, they may not get reassessed for 3 or 5 years. In some cases, they get reassessed at the point of sale. So you really want to understand that, and if those adjustments have taken place, because that can substantially impact the net operating income, something that Daniel was talking about at the beginning of the call. Insurance is impacting a lot of operators, in some areas more so than others, but that's another pretty large expense that you want to make sure has been validated with third parties like insurance brokers. And then the rest of the expenses, such as repairs, maintenance, property management fees. If the plan is to increase the rent substantially, you probably will see a pretty sizable increase in advertising expenses. And really understand that, especially as you're taking over a property, it does take some time for that property to stabilize, depending on what specifically that business plan is and how large the property is. If it's a smaller property, it could be 6 months to a year, but if it's a larger unit count, that stabilization period could be 18 to 24 months. So going from 0 to hero overnight, it's not something I've seen from practical experience. So something definitely to watch for as you study those rent growth and expense assumptions. The 4th item is reserves, and I'm referring to both the operating reserves and the CapEx reserves. So typically you'd like to raise, or at least as an operator, I would recommend that people raise the CapEx reserves, or substantially all, if not all, upfront, versus relying on covering those out of cash flow, because a lot of things could happen in cash flow, and we're going through a period like that today, where top lines are compressed, the expenses have increased for a variety of reasons, which is compressing the profit. So typically you'd like to raise that up front, and ideally those numbers will have been vetted by that third-party contractor that the operator is working with, and ideally have a little bit of buffer, 10-15%, because unexpected expenses always happen, change orders always happen. The other component of reserves is operating reserves. And personally, I'd like to reserve 6 months of operating expenses and debt service, which for the most part equates to, I guess another way to say it is 12 months of operating expenses. If I see anything less than in a deal, I personally get very nervous. Now, would I be comfortable with something like 4 or 5 months of OPEX and debt service? I would say maybe. But in that case, I personally would like to see other cushion levels within the deal, because the way to think about it is, you can, as an operator, right, you can, as you approach an investment opportunity, you always think, so what are the risks? What are all the things that can go wrong? And then you think through, okay, well, how do I mitigate those risks? And unfortunately, for better or worse, you cannot completely eliminate risk, right? Unexpected things will always happen, and they do occur. So I think of the reserves as that rainy day fund that is there to help me during unexpected or turbulence period, something I can dip into if or when needed. So hopefully I don't have to ask my partners or investors for additional capital. Now, the next item is the other most powerful lever that has tremendous impact in the valuation, and Daniel touched on it at the beginning of the call, namely the cap rate. Both the entry cap rate, which is the cap rate at the time you're acquiring the market cap rate at the time that you're acquiring a property, and the cap rate at exit. That has, as you saw from the little calculation that he did in the beginning, that has a multiplier effect on the property. And nobody knows where the market will be in 5 years, which is a typical hold period for a multifamily investment opportunity, or even 3 years. Nobody knows where the rates would be, what would happen to the real estate markets, or the overall macroeconomic and geopolitical events, all of which feed into impacting the cap rate. So the best you can do is plan for the worst and hope for the best. And what do I mean by that? Personally, I like to assume that the markets will get worse, meaning the cap rate will increase, meaning even if I do nothing else, all else equal, assuming the same NOI, my property will decrease in value. Now, of course, as an investor, you're not buying a property, so it decreases in value, and you're improving the NOI, which is one of the power effects of the value add model, because again, you don't impact markets, but you can impact the NOI. But if God forbid we go through a winter storm, I could have at least mitigated, or at least partially mitigated that market risk by making that assumptions. Now, the markets happen to be great when I am ready to exit my property and business plan, then it's even better. My valuation will be even higher than what I projected. Number 5 is, or number 6 rather, is really understanding the finance structure and how does it align with the business plan. And one hot topic, especially these days, is how is the interest rate risk mitigated? Now, in my personal experience, I've always done fixed rate debt deals, and some of that is also predicated by my lender background. There are different ways to hedge the interest rate risks. Fixing it, of course, is one way to do it, but there are other derivatives and other tools that lenders and financial providers can provide, interest rate caps being one of them, interest rate collars. But the underlying premise there is, again, as an operator, I really want to focus on the things that I can control. Again, interest rates is not something I control. And even if I have a view on where the market will be, I may or may not be wrong. If I knew where interest rates would be, I would probably be doing something else and not buying and selling properties. So, so focusing on the risk that you can control and really mitigating that interest rate exposure, but also making sure that the debt aligns with the business plan, right? If you're purchasing a property that will require some work and it's not quite stabilized, whether and especially if it's under certain occupancy levels, more likely than not, a traditional lender, right, or even an agency wouldn't be able to provide financing if it's not stabilized. So in that case, you're definitely looking at a bridge loan or short-term loan solution. So in that case, you're thinking through, what is my exit strategy? Or as an investor, I would be asking, what is the exit strategy? Because typically those bridge loans are for 1 to 3 years and they have extension options, but that's exactly what they are. They're options. The lender is in no way obligated to provide that extension. So really understanding what the exit plan is in those scenarios or in those situations. Alternatively, if you are getting into long-term fixed rate debt, and let's say the business plan is to execute and hold that property for 5 years, but out of precaution, you're getting a 7-year debt, a 7-year tenor because of other considerations. Well, in that case, it's prudent to bake in those prepayment penalties that typically come with those longer tenor fixed rate debt options into the valuations, or making sure that the operator has accounted for those, because again, those can be pretty substantial depending on the lender or loan provider. And last but not least is the promote and the fee structure. I would say for the most part, at least the deals I've come across have been pretty standard. But one thing I also look for is skin in the game, and how much is the GP team collectively putting into the deal. Typically that number ranges anywhere from 5 to 10%. And in most cases, that's monetary in nature, right? They're putting in money, but in other cases, it's signing on the loan and putting their name on the line and all of their personal assets and livelihood. So that's a pretty high bar to meet as well. But I want to understand that we're aligned in terms of objectives, and if I'm putting my hard-earned savings in, I expect them to be to walk the talk as well with me. So I hope today's presentation was helpful. I do want to pause for a moment and see if there are any questions that I can help answer, and whether it's about underwriting, markets, letting deals, and sponsors.
We'll open it up. If you want to speak on audio, go ahead. Also, if you want to, feel free to put a question into the chat box.
Um, how see nowadays? No, I live in Phoenix area.
Mhm.
Nowadays, like no, for the past one and a half year, I'm noticing that no, buying investment properties is becoming a really no difficult because of the cash flow problem. So, do you have ideas like no, how do we improve these cash flows? Because no, any investment property I'm looking at, like no, whatever I'm doing, like no, I'm not able to get into the positive side.
Mhm.
I'm talking like no, you are buying either new properties or resale homes. I'm not talking about the properties which you already hold for a long time with lower interest rates.
Yeah, you're talking about if you're to buy a brand new apartment building,
Yeah,
or
yeah. Uh-huh,
yes, yes.
uh-huh.
So the challenge you're experiencing, SM, is one I've been experiencing, and probably many other operators, because um, valuations were quite elevated for quite some time, and those, they have adjusted to some extent, but not fully. And so yes, there are certain things you can do, but for example, let's just take your example where you're looking at a brand new property, and specifically in the Phoenix market, where many properties currently they are experiencing some rent compression. So you're probably going to be more cautious in your rent assumptions, and maybe even projecting no rent increases for the first year, probably higher amounts of vacancy. So not much you can do there. You can project it after a certain period of time, but based on the market today, that's probably going to be aggressive. In terms of expenses, well, there's only so much you can cut to optimize the expense side of the equation. And again, while that is helpful, probably the biggest effect, like I said, on the property will be your top line and the cap rate. So really the only factor that would give in that case is the valuation, and making sure you're buying it at the right cap rate that's consistent, again, with the loan terms and interest rate. And that's been a challenge for many buyers. There has been a pretty sizable spread. Again, that is shrinking, and I think there are quite a few events that are coming up or will be happening this year that will generate some activity in the market, and hopefully more sensible valuations. But sometimes the best thing to do, especially in markets like that, is to wait for the right opportunity. And I'm not saying just sit and wait, but evaluating, continuing to look at properties, because that again gives you a really good pulse on the market, and you never know when the right one will come along. So I'm not saying sit on the sidelines completely and don't look at any investments. Continue to look at them, but also stick to fundamentals, because the last thing you want to do is overpay for a property or fudge the numbers and assumptions to make them look and make you feel better, but then not be in a realistic position.
Yeah, thank you.
And I put in my contact information as well, to the extent you guys think of additional questions, but definitely happy to take on more.
I have a question.
Yes.
Hi, Vessie. So when you do your vetting and assessment of these properties, do you have a team of people that help you with this, or do you do it all, following these steps?
Great question. So I currently vet the deals myself. I'm very grateful and happy to be receiving investment opportunities from various operators. Slightly different than the experience when I was initially focused on acquisitions, where you're underwriting. At the time, it was a deal a day. Now, granted, deal flow has reduced quite substantially over the past couple of years. I think that will be changing in the coming months. So long story short, all that to say that the volume is now a lot more manageable for me. So I have the opportunity to vet those deals directly and literally following the steps that I shared with you a moment ago in determining, okay, is that in line with my own criteria, with my own risk tolerance? Underwriting is an art and a science. I think everyone probably has a science component, but it's the art where you get the same inputs to 2 or 3 different people, and you're going to get 2, 3 different answers. And all of that is, again, predicated on their risk tolerance level, risk criteria. But the short answer is yes, I vet all of those directly by myself.
Okay.
And even for LP opportunities, because I invest passively as well, when I see a deal that initially hits my criteria, and usually you get those from various email lists or sponsors, then if it is a deal that I'm really interested in, I would usually ask to see their underwrite. They should be willing to share their Excel sheet with you. If they don't, for me, that's a red flag and I walk away. But when they share with me that's their underwriting model, I can very quickly see what assumptions they're making and determine then, is that in alignment with my investment approach? And if it's not, and or if they are not either responding to questions or not providing enough detail, then that's also a reason for me to walk away. Great question, Brooke.
Hey, Vessie, I've got a question, by the way. Thanks for coming in. So as you're trying to deploy funds going forward, right, with the sort of very sort of macroeconomic uncertainty, are there sectors that you're thinking, hey, this is safer than others, which you would consider deploying?
Great question. So on the active side of the investment, I believe in the power of focus and not getting distracted in a number of different directions. So on the GP front, I stay in the multifamily sector, specifically the stable value add space. I firmly believe in the long run, multifamily is positioned well, and for a number of reasons, which I'm happy to talk about. But also on a risk-adjusted basis, even though we are seeing increase in default rates relative to other asset classes, those default or delinquency rates remain the lowest. So in the long run, I continue to focus on that sector. With that said, like I mentioned, I also invest passively, and I personally would like to diversify my own real estate portfolio, so I'm not 100% in stable value add multifamily. So in my passive investments is how I achieve that diversification. And so a couple other asset classes that I have considered or that I'm currently invested in are, one is ATM funds. That has been a very strong cash flow generator for me. Recently invested in a new development deal. Again, my primary markets are in the Southeast, so that particular deal is in another market, which is more of an equity play versus a cash flow play. But I utilize my retirement account to do that, which again fulfills that investment objective there. I also invested in a tax abatement deal, again, in a different state from where I'm currently invested in. And I see that as a very safe play because, again, rents are experiencing in some markets compression, and in some markets they're reverting to more of the historical growth rate. And who knows what will happen this year. There's so many events coming up, both on the banking front as well as investment landscape and elections, not just in the US, but worldwide. So I view that tax abatement deal as a way to kind of weather the storm. And then, of course, I still have my single family portfolio. I love the residential space from that perspective. It's not the same as multifamily, but I think that is well positioned for long-term growth again, for a variety of reasons, which I'm happy to talk into. So hopefully that answered the question as far as what are some of the other areas or asset classes or subclasses that I'm looking at.
Yeah, and a follow-up on the ATM fund. Like, how did you do due diligence to make sure they are what they say they are?
Yes, great question. So again, I'm an LP on that deal, so most of my conversations have been with the sponsor versus me doing the typical diligence I would do as a sponsor, but definitely asked a lot of questions. For the last one, I even wanted to see a copy of their contracts, underlying contracts, understanding what kind of diligence the sponsor has done to vet both the operator as well as the deal. Have they gone and physically visited the warehouse of the famous ATM machines? Where are they installed? So also talking to other passive investors, and one of them is a pretty sizable one, actually. So they went and requested a CPA third-party validation letter of that sponsor, which eventually, of the operator, sorry, which eventually the operator provided. So between talking to the sponsor as well as other passive investors, comparing notes, that helped satisfy my initial inquiries, and I would say so far it's been pretty steady, no complaints there.
Great, thanks, Vessie.
So with multifamily being like a tough situation now, so share some other specific criteria that you look.
I lost the hear the full question. I'm sorry. Do you mind either repeating or maybe putting it in the chat?
Yeah, I can repeat. So with the multifamily, so what do you look for in those deals, such that you look for how many years the deal will be closed? Like, what criteria you look for to get into?
What do I look for in multifamily deals? Like, what are my criteria, basically? So I think that's what the question was, and I apologize, it was breaking up too much. So I think the question asked was, what do you look for in multifamily deals? Again, I usually start with the sponsor and the market first, and really the numbers is the last thing that I look at. But once I get to the numbers, of course, I want to make sure that that investment opportunity meets my criteria and that of my investors, which is typically around a 15% IRR. Which effectively means being able to double the capital over a 5-year period, 6 to 8% cash on cash return. For me, personally, it's extremely important. Again, I'm speaking more of the deals that I do on the active side. It's particularly important that the deal cash flows on day one. And so after expenses are subtracted and debt service and other sponsor fees, I want to see a positive number there, because again, that's another risk mitigation tool. I'd like to see a relatively low break-even occupancy. Again, that introduces some cushion and risk mitigation to the deal. And for me, low means 80% or less. I would like to understand again how they're mitigating the interest rate risk exposure. Ideally, it would be fixed rate debt, but if it's not fixed rate debt, then I'd like to see what other vehicles they're utilizing to manage the interest rate risk fluctuations. So those are just a few points to get me started. And of course, like I mentioned at the beginning, I definitely look to understand their assumptions, and if there are questions that are raised where I need a little bit more help with understanding why they're more optimistic in certain areas than others, then I'll ask those follow-ups to see if those align with my comfort level. And
I have a question. First of all, thanks for coming in, and I appreciate your breadth of knowledge. My question is, what is one thing that you wish somebody would have told you earlier that would have helped you, like within your journey? Like what are like a mistake you may have made that you could have avoided? So what's that maybe one or a couple things that you wish you would have known?
So I see a two-part question here in terms of what I really wish I had started 20 years ago. If I had started 20 years ago, I would have been in a very different place, but I'm still glad that I started because I don't want to have that regret 20 years from now. But specifically when it comes to operations and vetting investments, being able to vet the information via a couple of sources. So on one of the deals that we did, I had been working with a particular lender and who was very responsive to all the inquiries and questions that I had when I was in the process of sourcing deals. Again, I no longer source deals directly, and my partners are doing that. We got under contract, started moving forward with the diligence, and one beautiful day, he called me saying, sorry, we're shutting down our program. Good luck. I'm sorry, it was not even a phone call. It was an email. You never do that as a lender. But anyway, we were able to pivot and started dialing for dollars, so to speak. But loyalty and building relationships, that's of course key and very important, but especially when you're in the early stages of vetting opportunities, is talk to at least a couple of lenders. I know with insurance, the process is a little bit more tricky, but so maybe talk to another loan broker in addition to the one you already have. When you're vetting comps or getting the boots on the ground feedback, don't talk to just one property manager, or as an LP, if you have friends or people you know, like and trust in that market, have them drive by the property. Because I had cases where a deal is presented to me as a class B, and I later find out, no, it's really more like a C, but I guess eye is in the beauty of the beholder, as they say. So it was, maybe it was looking like a B to the sponsor, but leaning in on those third parties or other trusted sources you have within your network to validate the information presented to you.
Thank you. That was good.
Great question, guys. Thank you for making this interactive. Otherwise, it will be a speech, which I don't particularly enjoy hanging out by myself.
Hey, Vessie, question for you. Do you do, as part of your deal evaluation, portfolio evaluation, sponsor evaluations, do you look at pig-pal strategies, and if so, do you use that as part of your assessments, and if so, how?
What type of strategies? Sorry, I missed that. Pig pile, you said?
Pig and pal. So this is
okay.
So take your passive income and your depreciation. You're looking for a balanced offset so you can harvest on both sides, and blending the mix. So typically deals are going to give you one of those but not the other, or something to that effect. So how do you handle that, or do you?
Got it. Great question. I definitely like the depreciation benefits. For me, all of my deals are in active stage currently, but that is definitely going to be a consideration as some of those start exiting and figuring out what opportunities that I get in that give me that biggest benefit. Because especially right in the syndication space, doing 1031 exchanges, it's not impossible, but not all sponsors offer that, and it's not always it's not something always that you can do. So definitely did that. Now for many years I started investing while I had a W-2 job, and in those cases some of those tax benefits or tax deferral benefits that you get from a typical real estate deal aren't directly applicable to my, or were not directly applicable to my active income, but that didn't preclude me from investing, because those passive losses still offset other passive income. So on a net basis, they still reduce my effective tax rate. So definitely something I look at, but I would say if I was to prioritize my investment criteria in terms of cash flow appreciation, or tax deferral. I would say cash flow comes first, and then appreciation or the opportunity for value creation second, and then tax deferral is third in terms of my ranking. So hopefully that answered the question, but if not, we can talk more. Yeah, thank you.
All right, we've got 5 minutes left in the meeting. Are there any last questions?
I have a philosophical. Oh, go ahead.
Sorry, quick question. So do you find it more difficult now to invest because due to the current environment, and in the past, if you had the same type of situation, how did you overcome that?
Great question. It's definitely more challenging. There are always challenges. I'll tell you, even when the market was hot, there was so much competition, and so much deal flow as well. So the challenge there was, well, how do I, as an operator, right? How do I find deals that are sensibly priced? Now there isn't as much deal flow, and again, who knows what this year will bring? And some people will say recession, some say no, we're way past that. So that brings that uncertainty, makes things challenging. Also with a lot of loans coming due and properties being underwater. I think personally, I think we'll see further adjustment in valuations before things bottom out and start increasing again. So I guess the short answer is there's always been a challenge. Sometimes it's too much deal flow and trying to pick and choose which is the right opportunity, and is it sensibly priced? Because again, I think in the past couple of years, putting operations aside, there were either deals that were not bought right or not financed right, and it's creating a lot of challenges in today's market. Today, the challenge I have is, again, picking the most boring, I would say, investment opportunity. The one that will not look very exciting on paper, but the one that would be relatively safe on a risk-adjusted basis. And I had the privilege of evaluating a number of investment opportunities, I mean, at least one on a weekly basis. So I tend to say more no's than yeses. So that's definitely challenging because I would love to be able to have more investments, but what my experience has taught me, both as a lender and as an investor, is to adhere to fundamentals, and sometimes it's better not to do a deal than do the wrong deal. So patience helps in the long run, and that's the approach I've followed. So haven't done a ton of deals over the last couple of years, but hopefully looking to do more this year, but not at all cost. Only if the numbers make sense. And that's incredibly hard to do because there is also a lot of noise. You see friends, family, there's social media, and people are constantly touting how many deals they've closed or how many investments they've gotten into. And then you're always thinking, what am I doing wrong? Well, now we're seeing some of the answers. So staying true to your criteria and investment objectives is something that has been helpful for me, and I plan on continuing to follow that blueprint.
Everybody, can we have you take yourselves off mute? Oh, was there one more?
Sorry, Daniel, last question, I think.
All right.
So let's say I have a deal I did go through, and I was not sure whether to get in or get out. So do you help in those cases with some nominal fee or something like that?
Yeah, I'm happy to have done this for many LPs, and lately, unfortunately, the calls I'm getting are, "Hey, I have a capital call. What do I do?" Which is like, no, call me before you look at the deal, not after. But yeah, I'm happy to help with that. I'm an LP myself, so I do that also.
Oh, thank you.
Mm-hmm.
Everybody, take yourselves off mute and thank Vessie for coming in.
Thanks, Vessie.
Thank you.
Thank you.
Vessie. Great job.
Thank
you,
you,
Vessie.
Thank you. Thank you.
Yes,
Right.
Guys, really appreciate it. Thanks,
Thank you.
thank you,
Daniel.
Vessie.
Thank you.
Thanks so much.
Next week, we have Frank Zia, who's going to bring us to investing in collectibles, a non-real estate topic. See you all then.
Great. Thanks all.
Hey guys, bye.
Hey, Daniel, this is William.
Yes, William.
Yeah, I was wondering if you can hang out for a minute or so.
Sure.
Yeah. So I got that spreadsheet, and I'll go ahead and populate it and then have you take a look at it and try to share with you what I'm trying to do in terms of.
You're talking about this spreadsheet?
No, you had emailed me the link where all the past
all the past speakers.
Yes.
Yeah.
And so I was just going to put them in such a way that we can sort out. And let's say if I wanted to see all the speakers that did investments, I can just filter on investments and then get a list of and their links.
I should have crowdsourced this whole thing. I should have brought it up to the whole group. But here, let me stop sharing my screen while I find the file. But
no, I don't mind. And if there's too much of a strain on your voice, we can do it later.
My voice sounds terrible, but it doesn't hurt.
Okay.
All right. So here's all our speakers that have come to our club. Got a little over 200 or so speakers. What I did is I created a categories over here, and I should have crowdsourced this to the whole group. But you can come in here and say Hunter Brookshire. He did a local update, and honestly, I'm probably the better one for doing this because I remember all of these. I know not everybody was here for all of them. Note investing. Is this kind of what you're talking about?
Yes, it is.
Yeah. So if you guys want to work on this, give everybody editor access. It's kind of scary.
Yeah.
I'll drop it right here in the chat.
Okay. And I will see if I can put all those in there so that way you can be able to group stuff. And I was hoping to get the links so that you can if someone, let's say if they just joined and they wanted to get all the investing on a particular category.
If you want to get all the links, you come over here to alternativeinvestingclub.com, Speaker Hall of Fame. They're right here.
Okay. Can you put that link that in there, and I will in the chat.
Yeah. It's just our club page.
Let's see.
I need to update last week's.
All right. So yeah, and that way, I know you know it, but new people coming in don't have a clue how to filter through all of that.
Right. Honestly, I should improve the website so that there's some filter options up here.
Yeah.
Yeah. It's been on my to-do list for a while.
All right. So maybe I can this will help you out.
Yeah. Yeah, I wrote this site. It's all in Next.js and React. So I mean, I can give you source code to the website if you want.
I'm not a programmer.
Oh, okay.
So.
Right. Well, hey, thanks for the help.
All right. No problems. Get well.
Thanks. I'm working on it.
You're on the road. All right. Good. Good man. Take care.
Bye.